If you are poor, dividends will keep you poor. That is the truth, and anyone who says otherwise is either lying to you or, hey there, Lincoln here from BoAcademy.org. Every once in a while, I get worked up on this thing called dividends. Every once in a while, somebody brings it up to me and asks me what my thoughts are, or they just bring it up and my alarm bells start ringing. And last night, it happened again. So last night, my buddies Chris and Xavier from the They Want Our Sauce podcast had me on, and before the interview was over, before the chat was over, they brought up dividends, and they made a mistake because I had to go in on that. And when I got home, I was still thinking about it, and I wanted to make this video, but it's the morning now, and I'm still thinking about it. So I wanted to just come out and discuss dividends with you and how it's keeping you poor. If you're investing in dividend stocks, you're staying poor because you're being misled by people out there who have lots of money coming in and are making lots of money telling you that dividend investing is the smart thing to do. And it's not. It doesn't make any sense if you're poor. If you are poor, dividends will keep you poor. That is the truth. And anyone who says otherwise is either lying to you or they're not poor. So those are the only two options. I'm going to go through 3 points here and break down for you debunked dividends for you so that you can stop wasting your time and money on dividends. Because all you have is time and money, right? If you're trying to grow your money, those only two resources you have. The time you have to invest and the money you have coming in to put into your investments. And dividends are not the best place to do that if you don't have a lot of money today and want to grow that small amount of money into a big amount of money in the future in a relatively shorter period of time, not 40, 50 years, but let's say 5, 10, 15, 20 years. So if you want to build wealth, real wealth that will allow you to actually retire, dividend investing today when you're poor is not the best option. I'm going to walk you through all of that now. But before we get to that, if you enjoyed this video, please don't forget to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts so that YouTube knows that this is an engaging video and that you all enjoy it, and help me continue to make these videos. Now let's hop into why dividends will keep you poor. Before we get to the 3 reasons dividends will keep you poor, let's set the stage. Let's understand why we're doing this thing we're doing called investing, right? Trying to build wealth. What is our goal? So when we're young and we're relatively poor, we don't really have much money, we're making, say, minimum wage, or we're just starting our careers, we're not making that much money, we don't have a lot of money to start with. So our goal is to grow our money, build wealth over the long term. And the way we build wealth is by finding high growth potential investments and putting our money into them, as well as finding investments that build equity for us, right? Such as real estate, such as our own businesses. So we have the stock market that can help us build our money, right? Grow our money by investing in high growth companies that are appreciating in their value, in their stock price. So if you buy a company for $1 today and then tomorrow it turns into $10 per share, you just 10x your money. And usually with growth stocks, that happens much faster than with other stocks, like dividend stocks, much faster. So you have that on the appreciation side. But then if you want to build equity as well, you can put your money into things like real estate, right? You buy a house with mortgage, with debt, and over time, as you rent it out to other people who need a house to stay in, they pay off your mortgage for you. So they're building your equity for you. As time goes by, you build up equity in the house and it becomes more and more your own, and that builds your personal wealth. So we have those 2 types of wealth building, 2 means of building wealth. Notice in there I didn't say anything about income. With building wealth, your goal is to appreciate value and to build equity. Those are your goals. Income is a means of doing that. The income that you have coming in allows you to acquire more stocks at cheap prices that will appreciate in value. And that income can also be used to acquire real estate or invest in your own business and build equity in those assets. So those 2 things, those are the goals. You take your income, your money, and you build value, right? Using appreciation in stocks or anything else that appreciates in value. at a high growth rate. Or you acquire an asset that builds you equity in that asset through things like rent. So those are your options. Income buys you assets that appreciate in value, and your income buys you assets that you can build equity in. That's how you build wealth. So your goal should be to acquire more income and put it into the highest growth potential assets, right? And the growth potential is how fast they appreciate in value and how fast they build you equity and how much they build you. And finally, we have to understand that we have two stages of wealth. The first stage is building that wealth. The second stage is maintaining it, right? You have to build it first and then you can maintain it. When you're poor, when you're young, you must be in the building stage. You absolutely must be in the building stage or you will stay poor forever and never get to that second stage because you won't have any wealth to maintain. So today we're all here in this building stage and our goal is to appreciate our value and build our equity. And that's how we build actual wealth that we can get a stage 2 with and maintain it. So now we have our stage set. We have our means of using income to build wealth in these two columns. And we have our goal of building wealth so that one day we can maintain that wealth. So now let's talk about dividends and how they keep you poor. 3 reasons that the YouTubers and the TikTok invested moguls will not tell you because they make their money off of telling you that you can get rich quick and build passive income using dividends. Let's break this down. So there's 3 things here. There's bad returns for dividends. It doesn't make any sense, and I'll tell you why later. And there's no such thing as a free lunch. There's no such thing as free money. Everything comes with a cost, and that cost can be extremely high if you're not fully understanding of what your goals are and the different options you have at your disposal. So now let's hop into the first one. Bad returns. So the way you make money with dividends is via the yields, the dividend yields, and those average around 2 to 7% per year. 2 to 3 or 4% is the average around there. That's what you're going to get from most dividend stocks. And if you get very lucky to find some high dividend yield stocks which have their own problems that pay you out 5 to 7% a year, then you're doing very well. And you're one of the outliers we'll talk about later. And then there's the stock price appreciation, right? You want your stock to appreciate in value. And that's what we talked about earlier, appreciation of the value of your assets. But the problem with dividend stocks is that they're not built for optimizing appreciation because they're paying you all this money, right? So the appreciation that they have in their stock price value is up to 6%, starting from 2-3% per year to 6%. So you're barely gonna beat inflation, and at most you'll get 6%, 7% a year if you're lucky. So that crosses off appreciation because you can just invest in the S&P 500 or whatever and beat that easily, right? You'll get your 7 to 10% from the S&P 500 every year. Over the last 100 years, that's what it's averaged. So if you want appreciation, you want total returns, you can beat dividends by just putting your money into an index fund like the S&P 500, and you'll beat the total returns from your dividends. So if you want an example, let me walk you through one right now. Let's go to Market Beat and put the best inputs in and see what we get from our dividend drip strategy. By buying dividend stocks and getting our dividends every quarter, every year, and then reinvesting that dividend into our dividend stocks. Again, let's see what that gets us. So we go here and we put in $100, about $100, which is about 10% of minimum wage income every month. If we start with that, $100, we give our yield, our dividend yield 6%. We say it's taxable, and we're going to contribute $100 every month. That's about 10% of our minimum wage income. So we're contributing about $1,200 every year. We expect our dividend to increase, our dividend yield to increase by 15% every year. We expect to be taxed at 15% after making $40,000 and $400 in capital gains. So it's pretty much free money, right? It's pretty much, you're not getting taxed on it, up to $40,000. And we expect our stock price to appreciate by 6% every year. And we're going to drip. We're going to reinvest our dividends. Let's see what we get after 5 years of doing this strategy. We started at $100, and now we have $8,300. Our total return is 36%. Right there, it should give you pause. 5 years and all you got was 36%. Your average annual return was 7%. The S&P 500 can do that easily, and it has. And then there's total dividend payments over 5 years. Over 5 years, you made $1,337 in dividends. In 5 years. That's all you have to show for your dividend reinvestment strategy. With the best inputs, you're getting 6% yields, 6% appreciation, and 15% dividend growth, which is way, way, way too generous. And all you have to show for that is $1,337. Already, this should be ringing alarm bells for you. When you're poor, everyone likes to say, oh, you can't beat the stock market, you can't beat the S&P 500, you can't beat the professionals. Well, no, that's not true. If you just think about it for a second, the professionals can barely beat the market because, one, they're investing part of their funds into the S&P 500, so they're trying to beat something that they're investing in. They're trying to beat the S&P 500 while investing in the S&P 500. And they're dealing with much bigger money than you are, much bigger funds. You're dealing with hundreds and hundreds of millions of dollars and billions of dollars. So yeah, it's hard to turn 1 billion into 2 billion to get 100% return. But if you're poor, you can get from $100 to $200 very easily, and that's 100% returns. If you find a stock that actually is growing and appreciating at high growth rates, like say a Square or a Uber or a Upwork or a Facebook or many other stocks out there that are young and growing fast, you can easily beat 7%. You can get 15%, 25%, 50, 80, 100% on your money in a year. And your $1,000 now turns into $2,000. And that's a lot easier to do than the fund manager turning their $1 billion into $2 billion. So yeah, they may not be able to beat the S&P 500, but you can. So that's the other lie that those dividend gurus tell you, that you can't beat the S&P 500 or you can't beat the stock market, so just put your money in dividends and let it reinvest itself. All of this comes down to the fact that these bad returns are built into the system. They're by design. Dividends aren't meant to have good returns. What they're meant for, dividends are meant for maintaining wealth, not building wealth. That's why people who are already rich and have lots of money into the stock market, into these dividend stocks, millions of dollars and billions of dollars, or they're retired because they've worked their entire lives and they have millions of dollars saved to retire on, they can put all that money into dividends, and they built up that wealth over a long time, and they can make enough yields every year, 4%, 5%, 7% on their invested money for retirement, and live off of that money without losing their principal. That's what dividends are really for, to maintain your wealth and live off of it. That's when dividend income makes sense, when you're going to actually use it on yourself or go invest it in something better. So that brings us to the next point that you would hear from the gurus. It just makes sense. It doesn't make sense. And I'll tell you why right after this. If you're enjoying this video, do me a favor and like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts. And if you disagree with me, let me know why. Let's discuss it. And of course, you can join us in the Discord chat at patreon.boacademy.org. Now let's get back to our next point on why dividends are bad for people who are poor, and they will keep you poor. So the next point, and the one that those dividend gurus will love you to believe, is that it just makes sense. They don't make any sense, and here's why. If your goal is to grow your money, to grow your wealth, then dividends are near the bottom of your list of options to do that. Why is that so? Because the company is effectively telling you that they do not know how to grow your money better than you can. That's why they give your money back to you. Let me explain. So you go to company B and you say, hey, here's $100. Go invest this money and grow the business. And company B says, okay, thank you. And they spend a whole year working, and they grow the business a little bit. Then they come back to you and say, hey, we did our best, but we don't know how else to grow your money that you gave us. So we're going to give it back to you because we believe that you can use that money yourself to grow your own wealth, to invest it in something else that will give you better returns. We just can't beat growing our revenues by 2 to 3% every year. All we can do is 2 to 3% or even 6%. We believe that you can do better with this money than we can. There is many options out there for you. You could go and invest it into the S&P 500. You can go invest it into some growth stocks. You can go invest it into some growth ETFs. You can go invest it into your own business or buy real estate and get cash flows from rent and build equity at the same time. There are many options out there for you to use this money and invest it better than we can reinvest it. So we're paying out all of our shareholders half of our earnings because we don't know how else to use that money to grow our business. And we believe you can do better. They say all of that to you with the dividends, and then you go to them and say, hey, I have this great idea. I don't care what you just said. Here's that dividend you just gave me. Take it back and go invest it and build a company, reinvest into the company. And the company is like, I just told you we don't know how to grow this. You don't know how to grow your money for you better than you can. There's many options out there for you. Go do that. But you say, no, I like DRIP. It's free money. I'm going to reinvest it, my dividends, and acquire more shares and keep investing into you because I believe in you. And company B says, okay, whatever, man. And then they go back. They work hard. They grow the business by 2, 3, 6% again. And they come back to you again at the end of the year and say, hey, we have all this money that we have from our free cash flows, but we don't know what else to do with it to grow your money better than you can. So here is your money back, sir. Go take it and invest in some growth stocks, invest in real estate, invest in your own business, invest in better education so you can get a better job and increase your income. Here's your money back because you can do better than we can. And then you go and say, hey, I have a good idea again, sir. Here is my dividends back. Here is the DRIP. Go put it back and invest into the company and grow the business. And the company is like, what are you doing? We just told you we can't grow your money for you. You're poor. You should be growing your money, not giving it to us so that we can just get 2 to 3% for you or 6% every year. We're not here for you, sir. We're here for your grandma and your rich friend who's retiring at 40 because they spent all their youth invested in growth, in appreciation of the value of their assets, and in building equity in their assets. That's how they got to us, because now they have actual money that they can give us and actually make a meaningful income on it, and they can quit their job because their dividends replace their income. But you are not there. All we're giving you is $1,000 a year. What are you going to do with that money? You can't live off of that. So take that money that you're giving us and go invest it into appreciating assets and acquiring more equity in assets. And then come back to us in 20 years, in 40 years, and give us your money. And then you can live off of the income that we give you through dividends. And you still don't listen to reason. And you say, hey, sir, I have a great idea again because I heard it from that TikTok guy and that YouTube guru guy who's been investing for 7 years and somehow hasn't grown his money by more than 5x, 2x. He's the guy I'm going to listen to build wealth. He says to put my money back into my dividend stocks. Reinvest my money into dividend stocks. And the company's like, okay, whatever, man. We'll take your money. And then there's the other problem. The reason the company is telling you, hey, we don't want your money is because they realize that once you make enough money from these dividends, you're going to get taxed on them. You're going to get taxed heavily on them. Because what happens is if your dividends are not qualified or you're making enough capital gains to get taxed on your dividend income, what's happening is you're giving this company money and then they're going to give you a smaller amount of the money you gave them. And then what's going to happen is before it gets to you, before that dividend income gets to you, the tax man steps in and says, hey, I want 15% of that, I want 30%, whatever it is. They're going to say, I want my share. So in effect, you get less money than you gave to the company, And then you say, hey, company, thanks for that money. Here it is back. And you give it to them. And then they say, okay, cool. Here it is back. And the taxman steps in again. And he cuts your income. And you do that over and over again. And that is just so counterintuitive. It's counterproductive. Your goal as an investor is to minimize cost and to maximize your growth. So if you're giving someone money and they're giving you less of it, and then the tax man comes in and you're losing money, you're increasing your cost. It doesn't make any sense. I don't know how else to say this. So that's our second point. It doesn't make sense. The company tells you, we don't know how to grow this money better than you can. Don't give it to us. Go use it and invest in something else that will actually grow your wealth for you. And you don't listen to them and you tell them, hey, drip. Doesn't make any sense. But Lincoln, it's free money. And that's our last point. It's not free money. There is no such thing as a free lunch. There's no such thing as free money. Everything has a cost. And when it comes to dividend investing, the cost, the potentially heavy cost of this poor strategy is the opportunity cost. Remember, the opportunity cost of making one decision is the value you miss out on by not making another decision, some other decision. So if you choose option A, your opportunity cost is the potential returns that you miss out on by not choosing option B. So if you choose dividends as your strategy for investing and building wealth, you're going to get about 7% in total returns per year. You could have chosen S&P 500, which would get you 7 to 10%. You could have chosen growth investments, growth stocks. If you're investing actively, then even more reason that you shouldn't be investing in dividend stocks, because you could actively invest by picking your own growth stocks and get at least 15, 40, 100% in a year. And over your entire career, you could do 15, 30%. But no, you chose dividends and you're getting 7% at best. Or you could have put your money into real estate. If you want passive income, choose real estate. Because in real estate, you get the opportunity to both grow your equity and get cash flow. And you know what the real estate investors don't do? They don't take their free cash flow every month that they get from rent and put it back into the house that they got that money from. They take that free cash flow and they save it to buy their next house, because they know the more houses that they buy, the more equity they can build at the same time and the more cash flows they can get. Because your goal is to build equity and appreciation of the value of your entire portfolio. You're supposed to take that money and invest it into a better deal, into something that's going to get you more returns. So with real estate, you can get both free cash flows every month, that's your passive income, and you can get appreciation and you can build equity. Both of our pillars, right from earlier. Appreciation of value and growth of equity, building equity. That's how you build wealth. But instead you choose dividends, or you get a 7% from a company that's telling you, hey, we can't grow your money. So you're getting your passive income, but you get no appreciation and you barely get any equity. You're barely getting anything in return because your equity that you're acquiring from that drip is so little. If you had taken that income and invested it into something else, then you could actually make more money in income and then buy more of those shares that you want to acquire. Drip is a subpar way of reinvesting your money into your favorite stocks. So let's just talk about it. If you want to do dividends, fine, go ahead and do it. But if you do drip, you're losing out on better returns. You're losing out on acquiring more shares, because by putting all that money back to the same company that just told you they don't know how to grow your money better than you can, and they're only doing 6% in appreciation a year, you're losing out on an opportunity to go invest into your own business or into some growth stock or into real estate that would get you more returns that you could then take and put into that same stock so you can get more shares. So drip doesn't make any sense. Now I'm just ranting. But the point is that it's not free money. It's not free money. Everyone on YouTube and on TikTok wants to believe it's free money, but there's an opportunity cost to everything. And that's what they don't think about. That brings us to our conclusion. All I need you to remember from this video is that if you take a second to just think about what you're doing with dividends and drip, it will not make any sense to you. Just take 1 second. Most people don't do that because they look at the people on TikTok and on YouTube who are the outliers, who make lots of money, who can afford to tell you that dividends are great because they make their money by telling you that. They look at them and say, oh, it works. And then they just follow them like sheep. Don't be a sheep. Think for yourself. Take just a minute and think about what you're doing with dividend investing. You're getting bad returns. You're going against what the company is telling you themselves. And you're missing out on so many better opportunities out there to build your wealth. And the very last thing is that if you are making minimum wage or you're making, I don't know, $100,000 a year, whatever, and all you're getting back in return is 6% on that money, that's not a lot of money. How are you ever going to retire? You'll spend your whole life working until you're 65, until you're 70, because that's how long it's going to take you to actually build enough equity in your dividend portfolio to retire. Do you want to be spending your entire life working and dripping your dividends into more dividend stocks that are getting you 6% in appreciation and 6% in yields every year? That's what you want with a actual total return over the year of 7%. Is that what you want? No, it shouldn't be. You should not want to stay poor your whole life. You can do better. 7% returns is not good. You can beat 7%. 100% of $100 is $200. Right there, you beat 7%. You just did 100% returns. All you have to do was turn $100 into $200. 100% of $23,000 is $46,000. That's where I started. And now my portfolio is above $100,000 in just 2 years, less than 2 years. The YouTube gurus might say, well, anyone could do that. You were in the pandemic. So if anyone could do it, then why didn't you do it? Because you were too busy following the hype of dividends, the passive income. Stop following hype. Stop chasing money. Chase wealth, not passive income, not $100 from dividends. So that's why I don't like dividends today. In the future, once I have enough equity in my portfolio, in my entire net worth, and I can take that money and put it into dividends and stop working and live off of that. But I'm not there yet. You're not there yet. You're still poor. I'm still poor. We have to build our two pillars today: appreciation of the value of our assets and building equity in our assets. That's how we get to actual wealth. Not by trying to make 7% of our poor money. We don't have any money. Stop trying to chase income on that. Multiply that money by magnitudes, not by 7 percentage points. Not good. So that's what I have for you today on dividends and how they keep you poor. Hope you enjoyed the video. If you did, don't forget to like the video below, subscribe to the channel, hit the notification bell, comment your thoughts. Let me know what your thoughts are on dividends. Let me know if you're investing in them. And let me know what your strategy is, what your goals are, and we can talk about it. And of course, if you want to help the channel financially, join us over at patreon.boacademy.org. You'll get more access to me, get direct access to your investment questions, and be able to engage on Discord channel where we share knowledge, discuss the stock market in real time every day, and share news, rumors, and other ideas so that we can all find new deals, do our own research, come back, collaborate, and make better investment decisions together. And of course, you have a chance of winning $200 every month just to be a loyal and engaged patron. So if you're interested in all of that, hope to see you over at patreon.boacademy.org. I'm Lincoln with boacademy.org. Thank you again, and have a great day.